credit bubbles tend to pop. They always do eventually. And that's what we're seeing today. On top of that, we have tariffs. The tariff agenda is lethal as far as the credit bubble is concerned. It is exactly the same dynamic that we had in 1929 to 1930 when we had the popping of the Roaring Twenties credit bubble. We had the Fed, it was the first decade of the Fed with Benjamin Strong. And he believed in if you like, credit expansion to drive the economy. So, that's not too far different from current beliefs. On top of that, we had the Smoot-Hawley Tariff Act, which increased tariffs by an average of about 20% or slightly more. Now, in those days, I understand that consumer goods imported from abroad accounted for no more than 2 or 3 or 4% of total GDP. This time it is different. It is considerably more. The consequences of Smoot-Hawley Tariff Act Mark II are considerably greater than first time round. Not just because of the increased volume, if you like, of imported goods into America. Also, we have supply chains across the world which are affected by this. We also suspect, and the rhetoric has very much confirmed this, that other countries will respond with tariffs of their own. So we have this situation. I have no doubt at all that the EU will do just that. The UK is sitting on its hands trying to pretend that there is a special relationship. We have been treated better by Trump with 10% tariffs as opposed to the EU, which is, I think, 20% tariffs. And consequently, we just don't want to shout about our position too much because we don't want to upset President Trump. So, but going back to the point, the combination of a credit bubble bursting and tariffs on top were what drove Wall Street down from the highs in September 29 to the lows in 1932, middle of 1932, whereby the Dow lost nearly 90% of its value from top to bottom. And on top of that, we had about 9,000 banks going bust over that time and following that time. And, people say, well, the problem with the reason we had a depression was because of the contraction of money supply. What they failed to understand is the reason that money supply contracted was because banks went bust. It's the only way in which bank credit gets removed, if you like, from the economy, by banks going bust, or alternatively, people who owe debt to the banks going bust. Then it gets wiped out. It's as simple as that. But until then, what happens, and particularly since we don't have a gold standard of any sort, is that credit just gets passed on. But that's a slightly separate, I'm going off topic going in there. But the point to understand is that we have a combination of the largest credit bubble in history going pop and Smoot-Hawley Tariff Act Mark II, courtesy of President Trump, at the same time. Exactly the same dynamics, but worse than we saw between 1929 and 1930.
Oh, wow. That is
I'm sorry to say, I wish I could say something different, but that is the point. That is the point. And that's why, we're seeing today, I'm just looking at my screen here, we got, the sort of NASDAQ down 5%, and we've got, all these things are just falling apart now. And the idea that this is a sort of little bit of turbulence and don't worry, it'll sort itself out, I don't think so. And we can also talk about interest rates if you want to come onto that subject at some stage.
Well, yeah, let's do that. I do have a couple of other questions that you just said. So, but let's go to interest rates first. But in the broader scheme, you brought up a great point of somewhat what does this mean for the UK? I'm very interested in that, and it's obviously not good, but I want to work that out a little bit more. And also just with Europe, is this, I'm going to be dire here, but is this like, and I don't know exactly what this looks like, but is this the breaking apart of the EU or potentially that?
I think potentially it is. But I think that's probably a little down the line. I think there are probably more immediate things we should be discussing than that. Um, if you look at the UK, the main members of the EU, with the exception of Germany, we're all in debt traps. Now, basically, a debt trap is where the government debt increases at a faster pace than the revenue that it gets in. Yep. If we go into recession, slump, depression, whatever you want to call it, tax revenues drop, welfare commitments rise, budget deficits increase. So you have this situation where tax revenues are decreasing, but the creation of debt is increasing at a faster rate. In other words, we have a debt trap, okay? Now, so you've got to think, what are the foreigners going to do with you on a debt trap? Now, whether it's you in the United States or you in France or you in the UK or whatever, it's all the same thing. They're going to look at this and they're going to say, hold on a minute. There is a lot of risk in me holding this currency. This currency is going down. This sucker is going down. Do I really want to hold it? And the answer is no. And that's why we're seeing central banks buying gold. I think the point to understand is that what central banks are doing is not buying gold. They're getting the hell out of credit. That's actually what they're doing. They realize that there are increased risks holding fiat currencies. So they are adjusting their reserves to reflect their perception of that risk. And this is something which has only just started, in my view, because really, another way to put it is that you could say that, paint great pictures and say, well, we had Bretton Woods. That was chucked out in 1971. We then had the fiat currency era. That's now coming to an end. We're now going to have a new monetary system, which will replace the fiat currency era. Question, what is that going to be? Answer, we don't know. And it's particularly difficult because the whole of the West is stuck, if you like, on the idea of macroeconomics, neo-Keynesianism, the idea that the government has got to continue to stimulate the economy for the economy to grow. What is economic growth? Well, it's a complete non sequitur because you can grow the economy, but the GDP number is basically the amount of credit which there is in the system. It doesn't tell you what that credit is doing. So actually, the problem we have is that the guys monitoring this, their use of statistics and all the rest of it, is completely useless. They don't understand economics. They don't understand what they're doing. So how they're going to come up with a new system when they don't actually understand what they're talking about, this is going to be an interesting development. So, and I would like to mention something else. We see that central banks are selling dollars, selling euros in particular, and for all I know, selling sterling. They should be selling sterling, selling yen to buy gold. Okay. Gold is, if you like, their safe haven. I can understand that. I think we should all be able to understand that. But what does this mean for interest rates? Well, if you have a heightened risk in a currency, then quite obviously, by risk, what I mean is a risk that it will lose purchasing power, then the interest rate, which you as a foreigner would accept, if you like, to continue to hold that currency, should reflect your view of how the purchasing power of that currency is likely to go down or up or wherever it might be. There is absolutely no doubt that anyone holding a foreign currency is looking at that foreign currency and thinking, I'm not going to get as much real value, if you like, in a year's time as I have now. So the idea that the Fed can reduce interest rates, for example, and manage the economy and all the rest of it, and even, reduce interest rates so that all the zombie corporations who will go bust with interest rates of, say, 4, 5, 6, 7, 10%, are miraculously rescued. That's not going to work, because what will happen is that the foreigners won't hold your currency. They'll sell it. And that's what we're seeing today. I think the dollars trade weighted is down 2% or slightly more than 2% in one day. I mean, this is a major, major move.
Mm-hmm.
So, how do you counter this? Well, the answer is you've got to have higher interest rates. Interest rates are compensation for risk. It's risk at loss of value. And this is a point that nobody seems to understand. They seem to think, and this is Keynesian groupthink, basically. They seem to think that if we go into a recession, then interest rates go lower. No, they don't. Interest rates have got nothing to do with recession or growth or whatever. It is far more to do with the anticipated purchasing power of the currency, let us say, in a year's time. So if the anticipation is that the currency is going to lose more value, let us say, than the market expects, then interest rates are going to go up. Bond yields are going to go up. Nobody's going to lend you money, particularly if you're in a debt trap, anything like current levels.